I'm Howie Lim. This is Money Hacks by the Business Times. Elections, wars, assassinations, and terrorist attacks. Let's just call a spade. Geopolitical events. They can have quite an impact on stock market performance and across various sectors. What to do when these events affect your investments? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim, and if you have feedback or an idea for a podcast episode, do get in touch, btpodcasts@sph.com.sg. Helping us figure this out today, Thum, Equity Research Analyst, PhillipCapital, Charu Chanana, Chief Investment Strategist at Saxo, and Angelina Lai, CIO, St. James's Place Asia and Middle East. Now, elections, for example, can generate market volatility due to uncertainties about future government policies, and that could influence economic growth. Geopolitical tensions and disputes can disrupt international relations and economic partnerships. Here's Angelina Lai from St. James's Place.
The biggest topic recently is probably the US tariff. Now, we knew that 2024 was a year of the elections, and we have been saying for quite some time that 2025 is going to be a year of implementation. We also knew that as Trump came into office for the second term, that there was going to be quite a lot of policy volatility and therefore driven market volatility. And lo and behold, as soon as he was sworn in, the tariff discussions have started with a surprise announcement on Canada and Mexico, and unsurprising one for China.
And over 60 elections took place in 2024, involving some 60% of the world's population. Could some leadership changes have an effect on our investments as well? Here's Thum from PhillipCapital.
Looking at Canada or South Korea, those changes won't really have any material impact because, it's been seen in the long term that these new presidencies that are coming up will be quite positive for these countries. But I think the biggest change, like you said, is the US. With Trump coming in, he's going to change the whole landscape. And it's not going to just affect the US, it's going to affect a global landscape. More importantly, the tariffs that he's going to put in are going to affect everybody, not just the United States.
Leadership changes obviously always bring some level of uncertainty. It starts with political uncertainty ahead of the elections. And then once you're past the elections, it sometimes transforms into policy uncertainty. And then depending on what kind of policies we see, it transforms into economic uncertainty as well. And markets obviously hate uncertainty. And if it lingers on for a long time, it is a source of volatility for the markets. That's what we are seeing in a lot of these places, particularly the US. We have seen a massive shift in the administration's priorities. Economic growth was not great in most parts of the world. Inflation was a huge problem in many economies, and that forced the voters to ask for a change in government. And when that happens, you have a new administration coming in with a strong mandate. They need to bring out policies to be able to address those concerns that the voters have. So this whole shift is a lot for the markets to digest.
That's Charu Chanana from Saxo, who also feels that sectors heavily dependent on US government spending will be affected by Trump's re-election and tariff policies.
We are seeing big shifts in the priorities around defense spending from this new US administration. So that is a sector which is hugely dependent on what the policy stance looks like now. Other sectors that are hugely dependent on policy changes could be something like healthcare, something like financials. We are seeing a lot of trade disruptions, so a lot of those trade-related sectors as well. I think it really depends on which way the policy is going, but I would stay very focused on sectors that have a huge dependence on government spending.
So we are seeing that he has increased tariffs. He is trying to remove the illegal immigrants, or aliens as he calls them. Those were sort of a short-term impact on the labor supply. So what the US is going to face is what they have faced similarly during the COVID times. COVID times, there was a huge lack of manpower. And, going into what he's trying to do, he's basically just removing all these illegal immigrants that the small and medium enterprises depend on. So we're going to see this huge lack of labor going forward into the next few years. I would say the automotive industry will get affected because there will be a shortage of manpower. And one example we use would be the wine picking. Who's going to pick the grapes for the wine? It's not going to be a normal American citizen. It's going to be the illegal immigrants. So that's going to face some shortage of manpower there.
Singapore's export-driven economy may certainly be affected by these trade policy changes. Might this spell bad news for our money and investments? More with our experts from Saxo, PhillipCapital, and St. James's Place in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Claressa Monteiro in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. How much does the global political scene affect us as investors? We've talked about the impact US President Donald Trump's trade policies may have. Will those effects stretch to have an impact on our export-dependent economy here in Singapore? Here's Charu Chanana from Saxo.
It really depends on the whole trade system, how the realliances are formed. Singapore, I would say, has, despite the fact that it is export-dependent, two distinct advantages. One, politically speaking, it is a very neutral country. That comes to its favor when you have these trade tensions ratcheting up between some of the major economies in the world. And secondly, of course, Singapore is a major global hub for logistics. I think that comes to its advantage, particularly if we were to see supply chains really shifting in some ways or the other. Singapore will always be potentially a preferred location to, shift supply chains to, if that was the need of the companies, of the organizations, of the corporations and the governments as well, just because of its neutrality. Again, Singapore remains in a pretty stable position. Obviously, there's going to be some level of volatility and threats that it has to adapt to, but that's also the big saving grace for Singapore. I mean, its resilience comes from the fact that it has this huge ability to adapt to situations, despite that short-term uncertainty. Over the medium and long term, Singapore remains favorably positioned.
Well, that sounds optimistic, which seems to be the view Glenn Thum from PhillipCapital has as well. Let's not be negative Nellies.
Most people just look at the negatives. We always see that, they're going to increase tariffs, so China is going to get affected. But if you look at that, we're moving from a sort of a China plus one to a minus China plus one. So we're going to move over to ASEAN. And I think the biggest country that everyone is trying to shift to would be the next up-and-coming China, which would be Vietnam. So that would be beneficial for Singapore because Vietnam is in ASEAN. With all the factories moving to Vietnam, Singapore could benefit as they are the global financial hub in ASEAN.
The key impact coming back to it is parties and politicians, they come and go. And there may be short-term volatilities up or down, but actually over the long term, stock markets tend to go up. So when you actually are focused on the long-term investment horizon perspective, it's actually much easier to be achieving for a long-term goal.
That's Angelina Lai from St. James's Place, who also feels rejigging one's portfolio is a must, regardless of economic or geopolitical conditions. She uses the US tech sector as an example and the Magnificent Seven. So consider opportunities pretty much everywhere outside of the Magnificent Seven.
Since Trump came in, and even though there has been a relief rally, the IT sector has been seeing probably more volatility over the last 2 to 3 months than it has done for the last 2 years. And what we're really sort of seeing is a potential rotation of the leader, because the way that the market works, there's lots of investors, there's lots of potential sentiment driven, but actually from a professional investing space, we're sort of questioning, is that really the right place to be?
Charu Chanana from Saxo agrees that keeping an eye on one's portfolio is paramount, and we should just stick to the fundamentals and ignore the noise.
If you're a long-term investor, that really works better than responding to every piece of news that is coming out. But we still need to understand whether or not the policy shifts that are coming, are they just cyclical? Are they just tactical? Or there are really structural changes in this environment. So, for example, if you do think that there could be a structural shift in inflation, meaningfully different from what we've seen in the past. Policy rates, for example, meaningfully different from what we've seen in the past, 0% rates. But do you think we can go back down to 0%? That is something that demands a change to our long-term investing strategy as well. So maybe have more inflation proofing in your portfolios. What we see on the geopolitical front as well, if you do expect this protectionist policies, this polarizing world to continue to linger, then probably, some amount of defensive exposure, maybe to gold, something that is a multi-currency exposure as well. I think those things could become extremely relevant even for a long-term investor. I would not sit down and analyze every piece of news, but I would look at what are the structural themes that are going to be coming out because of this political change that we've had.
Glenn Thum from PhillipCapital also feels noise can affect investors, but sifting out the noise from legitimate information is key here.
So don't take your information from purely just one source. Don't just believe whatever the company is telling you, but also to reach out to research analysts like myself to ask for their opinions so you can get a better insight. I would say when any big news hits the market, that's when you should probably be looking for advice. Or when the company's financials are out, like let's say quarterly, every quarter is a good time to reach out to your financial advisor or to a research analyst to find out, do the figures match what the fundamentals or what their projections are showing. So that's a good, baseline, I would say, every quarter minimally to go and reach out to the analyst or to your financial advisor. Because financials change every minute. So a quarterly, I would say, is the minimum, is the baseline. Every day is definitely not advisable because you would just get high blood pressure if you look at your shares every day.
So the takeaway, focus on the fundamentals, ignore the noise, get educated, and stay invested. Thanks to Glenn Thum, Equity Research Analyst, PhillipCapital, Charu Chanana, Chief Investment Strategist, Saxo, and Angelina Lai, CIO, St. James's Place Asia and Middle East. Next time, are there opportunities in the real estate sector to boost our portfolios? And what is the research saying about APEC real estate trends? I'm Howie Lim. This has been Money Hacks from the Business Times. Thanks for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.